Hi everybody, Randall Morrow with RESNN Investments. And today we're going to talk about real estate asset classes. And what is that? It's basically the quality of the building that you're planning to invest in. Initial reaction would be, well, that's an obvious thing. Better quality means a better investment. And some would agree with you, but it's not so simple. So let's dig in. First off, we break down the qualities by letters. So we start with Class A and move our way down, B, C, etc. So a Class A building is going to be a higher quality building, generally in a city center. It's going to be newer, updated, a real prime location. What you're going to see in those buildings is higher end finishes and amenities, elevators, security. And as a result of that, you're able to charge a higher rent and attract a higher quality tenant. You're generally going to see law firms or financial firms in these larger buildings. A Class B, on the other hand, is going to be a slightly older building, might require a little bit of renovation, and it's going to be a little further out of the center of the city. Not necessarily a bad thing, just attracts a different level of tenant. So what you're going to see in a Class B is smaller businesses, maybe startups, and the quality of the building is just a little lower. So you're going to have standard finishes and amenities. You'll probably have an elevator, but it's not going to be super fancy. You're not going to have security. You're not going to have paid parking, things like that. And then to crank down the level one more, you have a Class C. These are the oldest buildings. They're generally outdated. They're in less desirable locations, and they're very basic. They might have window AC units, obviously no elevators, and they attract a more budget conscious or small business. And real quick, just to point out, asset classes apply to all types of real estate. So we can be talking about an apartment complex just as easily as an office building. When you think of what type of tenant is going to want to pay more to be in a Class A, right in the middle of the city, or a Class C where they're a little further out and they're more budget conscious. So what are the advantages and disadvantages of them? The first one for Class A is, as I'm sure you've heard in real estate, it's all about location, 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 location. And so with a Class A, you're going to get a higher quality tenant, and you're generally going to get a longer lease as a result. So that's more stable income from an investment perspective. But because this is a much more expensive building, you're going to have higher operating costs. Obviously, the tenant expects the building to look great, and so you've got to keep it looking, at its prime. The other downside of a Class A is because it's much more expensive, you're limiting the tenant pool, the amount of people that are interested in that type of rent, that type of location. Going down to a Class B, you get a larger pool of tenants because it's less expensive. But the trade-off, and some people look at this as a good thing, is that you have a shorter lease time as well. So why would that be good? So shorter lease, tenant moves out. Now suddenly you can bring in a new tenant at the current rates. So you can raise your rent more often. Why would that be a bad thing? Well, if the economy is bad and you have a tenant move out, suddenly you got to lower your rent to attract a new tenant. So good and bad in that regard. Going down to a level C, you have a much less expensive, lower operating cost building. So it's easier to get into these in terms of a cost perspective. With that said, you also have more opportunity because you can add value and potentially get that up to a B quality building and then raise rent. So there's more of a value add opportunity there. The important thing to remember about Class C is you're in a less desirable location. So you have to kind of consider that in terms of if you put a bunch of money into this building, it's never going to be a Class A quality because of the location. So there are certain C's that can become a B quality property, and there are certain C properties that will never, ever because of their location. The other disadvantage of a Class C is that you have more renovation costs. You figure if you have a 30-year-old building and the air conditioning system has never been changed, you've got a large cost coming to you, or potentially the roof has never been fixed or changed. So you have more repair costs to consider. And lastly, you're going to get a lower quality tenant. And that may be okay, but it's just something to be aware of, that you may have to work a little harder to get paid every month, or you may have a higher turnover as a result. So which is the better investment? Well, the long story short is there's no right answer. It really depends on your risk tolerance and your investment strategy. They're all great, so it really depends on what your feeling is. And the reality is, one is going to feel more right for you than the others. But it's also important to break it down by the economy and whether we're in a good or bad market. You have to look at the economic cycles. And if you think about what happens when the economy goes through a recession or a depression and how people react, it kind of makes sense. So in good times, people want to be in higher quality properties. Businesses are going to spend more to look good to their customers. And in bad times, the opposite is the case, that although they still want to look good, they're tightening their belt. They're being cost conscious and being careful. So what you'll see in a typical economic cycle is, in good times, the Class A type buildings are highly desirable. There are going to be a lot of people wanting to get into these buildings. And then as the economy starts turning and we move closer to a depression or recession, what you'll see is those A tenants will move out and move into a B building, and B tenants will move into a C building. And so what you see is that the B and C type buildings have much more resiliency. They're less sensitive to economic moves. And so they're more stable, or lower risk, if you will. So there's a good and bad of all three, depending on which cycle you're in. And one thing I want to add is diversification is really important. I want to have low risk. And so for me, I want to be invested in all three of the asset classes. And that really lowers my risk level, whether it's a good market. I'm going to obviously be much more profitable in my A-type properties. And in a bad market, those A's are going to struggle, and yet my B's and C's are going to do quite well in those markets. So overall, my portfolio is doing well kind of all the time, if you will. So in summary, there's a lot to consider. And the important thing is that there's no right answer. One is going to feel more right for you, but also they're all good. So certainly if this is your first purchase, go with the type of property that feels more appropriate. But as you start adding properties, I would encourage you to move around to different asset classes for that diversification and lower risk factor. So I hope this helped. I encourage you to keep digging in. Look at real estate as a potential way to diversify your stock and bond portfolio and lower the volatility. That's it for now. Safe investing to you. Bye-bye.